All right, welcome to this explainer. If you're a chartered accountant, a tax professional, or a business owner, you know that new tax laws always bring a few surprises. Today, we are unpacking a really important one, Section 126 of the new Income Tax Act 2025, and exactly how it handles your health insurance premium deductions. Let's get right into it.
Let's kick things off with a real-world scenario. Imagine you've got a client, let's say a business owner, who's paying health insurance premiums for their own family, plus taking care of the medical needs of their senior citizen parents. How exactly does this brand new 2025 Act handle those deductions? Are the rules completely different now? Well, stick around because we're going to break it all down.
Here is our quick roadmap for today. We'll start with an introduction to Section 126, then decode the legal provision itself, run through a practical tax example, look at compliance and transition steps, highlight common practical issues, and finally, summarize the key takeaways.
Okay, Part 1, Introduction to Section 126.
Now, you might be looking at Section 126 and thinking, hey, this feels familiar, and you'd be absolutely right. This is the direct successor to our old friend Section 80D from the 1961 Act. But lawmakers didn't just slap a new number on it. If you look at the recent CBDT transition FAQs, a massive shift you'll notice is the terminology. We are finally ditching that confusing previous year versus assessment year jargon. Section 126 operates strictly on the unified tax year concept. It is so much cleaner.
Moving on to Part 2, Decoding the legal provision.
So who actually gets to use this? The applicability is pretty straightforward. Section 126 is exclusively for individuals and Hindu undivided families, or HUFs. The government's objective here is the exact same as before. They really want to incentivize health coverage. So for an individual, this covers premiums for yourself, your spouse, your dependent children, and your parents, and as we'll see in just a second, it also throws a vital lifeline for actual medical expenditures for senior citizens who might not even have a premium.
Now let's talk numbers. The monetary limits have thankfully been kept around to give us some continuity. You've got a standard baseline deduction limit of 25,000 rupees for your immediate family. But if the insured person is a senior citizen, boom, that limit doubles to 50,000 rupees. And this exact same framework applies to parents. So mathematically, if both the taxpayer and their parents are senior citizens, you are looking at a maximum possible aggregate deduction of up to 1 lakh rupees.
Within those limits, there is a really cool carve-out: preventative health checkups. The new rules allow a deduction of up to 5,000 rupees just for getting routine checkups. But here's the kicker, and you definitely want to remember this. While standard insurance premiums absolutely must be paid via non-cash methods, like UPI or bank transfer, this specific 5,000 rupees checkup limit can legally be paid in cash. Just remember though, it's not a bonus amount. It sits firmly inside your overall 25,000 or 50,000 rupee limit.
Okay, building on that, what if you have a senior citizen parent who just can't get a standard policy because it's prohibitively expensive? Section 126 has you covered. You can deduct actual medical expenditures incurred for a senior citizen up to 50,000 rupees. But there is a huge string attached here. You can only claim this if absolutely no amount has been paid to keep a health insurance policy active for that specific person. Basically, no double dipping is allowed.
All right, Part 3, let's look at a practical taxation example.
Picture a taxpayer, let's call him Mr. Sharma. During this new tax year, he pays 30,000 rupees through his bank for his non-senior family's health insurance. He also wires 60,000 rupees for his senior citizen parents policy, and just to be safe, he drops 5,000 rupees in cash for his own preventative health checkup. Put your tax professional hat on for a second. What is his total eligible deduction under Section 126?
Got a number in your head? If you said 75,000 rupees, you hit the nail right on the head. The total deductible amount is exactly 75,000 rupees. Let's break down exactly why. Here is the math. For his immediate family, he paid a 30,000 rupees premium plus that 5,000 rupees cash checkup, right? That's 35,000 rupees total. But because nobody in his immediate family is a senior citizen, his deduction is strictly capped at that statutory 25,000 rupees limit. For his senior parents, he paid 60,000 rupees, which gets capped at their 50,000 rupees limit. So even though Mr. Sharma literally spent 95,000 rupees out of pocket, his legal claim under Section 121D6 maxes out at exactly 75,000 rupees. Let's jump into Part 4, Compliance and Transition.
Knowing the math is great, but as we all know, the paperwork is where the real magic happens. You need a bulletproof compliance protocol. Step 1. Always verify the payment mode. Aside from that 5,000 rupee checkup exception, paying a premium in cash will instantly nuke your deduction.
Step 2. Documentation. The assessing officer will want proof, so per the income tax rules, keep those digital policy documents and bank receipts ready for audit. And Step 3. Ensure everything is properly aligned with the new tax year format when you're filing those digital returns.
Now, what if a client pays a massive, multi-year premium upfront? Section 126 handles this using an appropriate fraction method. Basically, if you buy a 3-year policy in a lump sum, you can't claim all of it in year 1. You have to amortize it. The formula is simply 1 divided by the total number of relevant tax years. This guarantees that the deduction is spread out fairly across the entire active lifespan of the policy.
Part 5. Common practical issues. Look, people make mistakes, but we want to avoid these common traps. Trap number 1. Paying standard premiums in cash. Just don't do it. Trap number 2. Trying to claim that $50,000 senior citizen medical expense when they already have an active policy. The system will catch that. Trap number 3. Confusing the old assessment year terminology with the new tax year on the portal. The guidance notes specifically warn about this one. And finally, mistakenly adding the $5,000 checkup on top of the max limit instead of keeping it securely inside it.
Okay, Part 6. Summary and key takeaways.
Let's wrap this all up. 1. Section 126 of the ITA 2025 officially replaces our old ADD. 2. The standard limit is 25,000 rupees, jumping to 50,000 rupees for senior citizens. 3. Cash payments are a huge no-no, except for that specific 5K preventative checkup. 4. Senior medical expenses up to 50,000 rupees are allowable, but only if no premium is paid for them. And 5. Lump sum policies must be proportionally divided over the relevant tax year.
Thank you for watching. Please like, subscribe, and share. Disclaimer: this explainer is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational explainer. Before you go, here's a thought. As we fully transition into this new unified tax year regime, how are you going to proactively restructure your clients' portfolios to maximize these streamlined deductions? Stay sharp out there, and I'll catch you in the next explainer.